Welcome to this explainer. Today, we're taking what a lot of people might see as just dense regulatory text, Indian Accounting Standard 1, or IND AS 1, and we're going to transform it into a dynamic, strategic toolkit for business executives. Look, if you're sitting in the C-suite, on a board of directors, or if you're analyzing corporate health, you might honestly be tempted to just leave the accounting standards to the accounting department. But let's be real, those accountants are the unsung heroes of corporate strategy. They're navigating a sheer volume of rules that would make a lawyer dizzy. Understanding the actual architecture of IND AS 1 gives you a massive advantage, because it's literally the foundation of how your company's financial story is told to the outside world.
Right, so let's dive straight in with the absolute core objective of IND AS 1, which is beautifully captured right there in paragraph 1. It explicitly states, the goal is to ensure comparability. This right here is your North Star. IND AS 1 is not just some annoying compliance hurdle or a bureaucratic checklist to tick off. No, it is the ultimate engine for comparability and financial transparency. It ensures that when an investor looks at your company this year versus last year, or compares you to a major competitor, they're speaking the exact same language.
Here is our roadmap for today's explainer. We're going to cover 1. The universal business language, 2. The transparency blueprint, 3. Core executive principles, 4. The power of comparability, and finally, 5. Beyond the numbers.
Section 1. The universal business language.
Okay, think about paragraph 9 for a second. It defines financial statements not as mere math, but as a structured representation of your business's financial position and performance. This is absolutely crucial for executives to grasp. These statements are the primary tool that investors and creditors use to predict your future cash flows, like both their timing and their certainty. They don't just show where you've been, they're the tea leaves the market reads to figure out exactly where you're going. Your stewardship of the company's resources is on full display here.
Section 2. The Transparency Blueprint. Now, according to paragraph 10, a complete set of financial statements isn't just a profit and loss statement. It's an interconnected ecosystem. You've got your balance sheet, your cash flows, the all-important notes, and of course, prior period comparisons. Presenting all of these with equal prominence ensures you're giving your stakeholders the full, unvarnished story of your business's true economic reality.
And here's a huge point from paragraph 32. There is a strict rule against offsetting. Basically, you generally cannot net your assets against your liabilities or your income against your expenses. Now, why does this matter so immensely to you as a leader? Because offsetting literally obscures your underlying financial risks. If you hide a massive liability behind a slightly larger asset, well, investors just can't accurately assess your risk profile or future cash flows. True transparency demands that both the gross exposure and the upside are clearly visible on the board.
Section 3. Core executive principles.
First up, we have the true and fair view. Financial statements absolutely must present a true and fair view of the entity's financial position. What this means in practice is faithful representation. Applying IND AS practically guarantees you are faithfully representing your business's reality to the market. In fact, in the extremely rare event that complying with a standard would actually be misleading, management has a literal duty to depart from it just to maintain that true and fair view, provided they fully disclose that departure, of course. That is how paramount transparency is here.
Next is the going concern principle. And listen, this is definitely not a passive assumption. Management must actively assess the company's ability to survive. You've got to look at least 12 months ahead from the reporting period. If there are material uncertainties, say you have a massive debt repayment coming up and absolutely no clear refinancing plan, you must disclose those uncertainties. It forces executives to be forward-looking and, quite frankly, brutally honest about the company's viability.
Another really vital concept here is materiality. Materiality essentially dictates that you shouldn't obscure vital data with trivial details. An item is material if leaving it out or misstating it could influence the economic decisions of your users. This means you have to present each material class of similar items separately. It completely empowers executives to filter out the noise and ensure every single line item on that report helps users make solid, informed economic decisions.
Which brings us to Section 4, the power of comparability.
So a major part of this comparability is actually structural. Paragraphs 60 through 69 require a strict separation of current versus non-current assets and liabilities. And this is not just accounting trivia. It is a vital structural divide that instantly signals your working capital liquidity and your long-term solvency to the board and to investors. If a liability is due within 12 months or within your normal operating cycle, it's current. This simple binary classification allows investors to instantly compare the short-term health of your company right against a rival.
And this structural consistency feeds directly into inter-period comparability. IND AS 1 actually mandates that you retain your presentation and classification from one period to the next. You must provide a minimum of one preceding period for all amounts reported. This rule ensures that executives are always comparing apples to apples across years, locking in that comparability. And crucially, if you change an accounting policy retrospectively and it has a material effect, you're required to present a third balance sheet from the beginning of the preceding period. So there's no moving the goalposts without leaving a very clear trail.
You can really see this comparability in action on the Statement of Profit and Loss. Paragraph 102 provides an exact template for analyzing expenses by their nature. So, instead of lumping costs into vague, functional buckets like administrative expenses, you must aggregate them by nature, things like depreciation, raw materials, or employee benefits. This makes the P&L deeply transparent and incredibly simple to compare across different companies in your industry, because it completely eliminates arbitrary functional allocations that can easily hide inefficiencies.
Finally, Section 5, Beyond the Numbers.
Listen, the notes section is where the true narrative lives. It is not just an appendix. Think of it as the director's commentary. Here is where you detail the significant accounting policies, like whether you use historical cost or fair value. You must disclose the specific, complex judgments made by management in applying those policies. The notes uncover unrecognized contractual commitments and contingent liabilities. They basically explain the how and the why behind every single number presented on the main statements.
Crucially, under paragraph 125, you as an executive must explicitly disclose assumptions about the future and major sources of estimation uncertainty. If you have an asset or liability whose carrying amount has a significant risk of a material adjustment within the next financial year, maybe due to pending litigation or technological obsolescence, you have to tell the users. You're essentially handing investors a map of your most sensitive financial landmines.
And, super importantly for senior management, IND AS 1 demands highly transparent disclosures about your capital management. You have to explain your qualitative objectives and policies for managing capital. Are you complying with external regulatory capital requirements? If you aren't, well, what are the consequences? This isn't just dry accounting data. This is your corporate governance and strategic risk management laid completely bare for your stakeholders to see.
So, as we wrap up this explainer, I want to leave you with this provocative thought. Are you just checking the compliance box, or are you utilizing IND AS 1 to master the universal language of financial transparency? Because when executives truly embrace the spirit of comparability and rigorous disclosure, financial statements transform from a tedious regulatory burden into your absolute most powerful tool for building trust and communicating strategic value to the market. Thank you so much for joining me for this deep dive into IND AS 1.